The following podcast was recorded on Tuesday, March 5th, 2024, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or biancoresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim discusses what it means that the stock market is down to the fabulous four. Jim, the stock market's year-to-date gains are more concentrated than just about any historical period. What are the fabulous four?
Yeah, so if we go to the first chart, the fabulous four are Microsoft, Amazon, Meta, and NVIDIA. Those are four of the magnificent seven. As this table shows, so far, those four stocks, Microsoft, Amazon, Meta, and NVIDIA, have a market capitalization of $8.3 trillion as of the night of March 4th. Those four stocks have increased in market value by $1.8 trillion so far this year. And those four stocks collectively are 58% of the gains in the stock market year to date. Or sorry, 61% of the stock market year to date. I read the wrong number there. And so this has been extraordinary that half of the gains in the stock market this year have come from four stocks. So if we go to the next chart, it shows the impact of the fabulous four on the S&P 500. And the four stocks, Meta, Amazon, Microsoft, and NVIDIA, have pushed up the S&P by 4%. All the other 496 stocks have pushed it up by 2.6%. So if you go to the next chart, let's look at it now for the NASDAQ 100, or which is what the underlying index for QQQ. It's even more extraordinary. Again, there's still $8.3 trillion of market cap. The NASDAQ is up 1.79 trillion. 85% of the gains or thereabouts of the NASDAQ have been four stocks. So if you go to the next chart, you can see that basically when you put it together, all of the gains in the NASDAQ 100 this year have come from four stocks. The other 96, the market is effectively unchanged. And that's to the 4th. The day we're recording on the 5th, the stock market's down 1.4%. So that's probably going to severely reverse a lot of these S&P 496 and or NASDAQ 96, taking out those four stocks. So if we go to the next chart, what the next chart shows is what happens when the fabulous four are removed. So the previous set of charts I showed were contribution charts. How much of those four stocks did they contribute to the overall S&P 500 or NASDAQ 100? What if they were their own indices? Well, they're barely up on the year. And again, this is before the sell-off that we're seeing on March 5th. And so these could be actually down on the year. So if you take out, what I'm trying to argue here is if you take out these four stocks out of the stock market, the rest of the market is not doing a whole lot. So if we go to the next chart, I wanted to show one more thing about concentration and talk about this as well. This is a little different measure because this is kind of the metric we use. I didn't want to go with the four. I said, what is the concentration of the S&P in its five largest companies? As of 2 days ago, it was 25.62%, or a little over 1/4 of the S&P is five companies. And those are Microsoft, Apple, NVIDIA, Amazon, and Alphabet. So this is a little different than the fabulous four. When was the last time we saw five stocks consume this much of the market cap of the S&P? It happened to be exactly 60 years ago, 1964. And I show there that was AT&T, General Motors, Exxon, IBM, and Texaco. So what we're seeing in terms of the concentration is extraordinary in this market, that we've seen this much concentration and especially being driven by 4 stocks.
So Jim, speaking of that, have we seen this before?
Yeah, so if we go to the next chart, there is one close example, and that's the tech bubble peak of 99. And so the orange line on this chart is the S&P 500 Infotech Index. This is the technology stocks within the S&P. And it starts on January 1st of 2000. January 1st of 2000 to March 27th, the technology stocks, these were the old internet, Cisco, JDS Uniphase, Pets.com, those kind of companies, Broadcom, those kind of companies. They were up 29% for the first 3 months of 2000. At the same time, the blue line, and that's shown by the green arrow, the blue line is the X Infotech. So this is every other stock in the index. They were down 12% over the same period. Now, I've used the metaphor here in looking at this, that it is much like an electric motor that you turn on a grid, and it would consume so much power to run that you see sparks flying and transformers blowing everywhere else in order to keep this thing going. To keep technology stocks going, they actually were taking money away from the other non-tech stocks to feed that beast. And that is something that we haven't really seen. And what it resulted in is the next chart. The percentage of the S&P that was made up by technology stocks peaked at 33%, which is the highest weighting of any of the 11 S&P sectors. The 11 sectors are, energy. Well, in addition to technology, you got like energy, financials, healthcare, consumer discretionary, utilities, basic materials, industrials. Those are the big sectors. The S&P technology sector hit 33% by the summer of 2000, and then fell to 14% by October of 2001, a month after 9/11. So you could ask the question, well, couldn't it have been that technology was so transformative that what it was winding up doing was it was revaluing technology stocks up, but making everything that wasn't a technology stock worth less? That's possible, but then you wouldn't have seen that the technology fall off the cliff, the weighting on the S&P fall off the cliff. The reason it fell off the cliff is because the technology stocks peaked and they crashed. So no, it more looks like that was basic bubble behavior. So let me continue with my metaphor where we are right now. Where if 99-2000 was when you flipped on the machine called the S&P technology, it blew the transformers and everything else because it sucked money and everything else went down. What's happening now with the Fab 4 is when you flip the machine on with that AI, the lights are dimming. Maybe not necessarily that we're blowing transformers and that we're seeing everything else that's not an AI stock collapsing like we did in 2000. We're not quite there, but we're still at an extraordinary period where we're seeing the lights dim, that really all the money is being sucked. Over half of the gains in the stock market are 4 stocks in the S&P. All of the gains effectively in the NASDAQ 100 are 4 stocks. So this is not the most extreme we've ever seen, but it's pretty close to one of the most extremes and one of the more extraordinary periods that we've seen, consistent with the Nifty 50 stocks in the 1970s and the technology stocks in the 1999.
Jim, what does Wall Street need?
Yeah, so let's go to the last chart. What I'm arguing here is that there's not enough money to go around. Now, what are you talking about, Jim? Come on, S&P's at an all-time high, NASDAQ's at an all-time high, gold's at an all-time high, Bitcoin's at an all-time high. Yeah, but a lot of these things are small. The S&P, Bitcoin is $2 trillion. Gold is a very small market. The S&P is being driven by 4 stocks. The NASDAQ is being driven by 4 stocks. But Germany's at an all-time high. Yeah, but the German stock market is smaller than, than the Fab 4. It might even be, basically Microsoft and Apple. That's how small the German stock market is. If you look at the Russell 2000, it's actually only retraced half of its 2021 to 2023 loss. It's only retraced half of it, where the S&P is 7% above its 2020-21 peak. So yeah, what I would argue is that there's not enough money to go around for everything. So I'll express this with this chart, our market cap to GDP chart. In March, and this goes all the way back to 1926. In March of 2000, it hit 183%. What happened then was something similar to what's happening now, is that the market got so big, it didn't have enough money for everything. It only had enough money for the technology stocks, and they were blowing transformers, and eventually it peaked, and we had the tech crash right after that. Then in November of 20, and why did it get up to that high? Because we were feeding it cheap money. Remember now, you got to be a certain age to recall this, but back in 1999, one of the things we worried about was Y2K. We were worried that all of the computer systems had as their date function the last 2 digits of the year. So the last 2 digits of the year said it was 99. And when January 1st came, it would go from 99 to 00, and they were afraid a lot of computer programming would think, oh, it's now the year 1900. So instead of me giving you your bank release or your bank transfer on January 2nd, 2000, I will give it to you in 100 years, so you wouldn't get your money. So we were all worried about that, and we spent an enormous amount of money trying to fix the coding ahead of Y2K. We all know now, in hindsight, that it kind of came and went without an issue. But in October of 99, the Federal Reserve put together a special liquidity facility. What the Fed was worried about was people were going to be so worked up about Y2K that everybody was going to run to the bank in December, 3 days before the end of the year, and take out a couple of $1,000s in cash from an ATM. And like every person in the country was going to do this. And there wasn't enough liquidity or physical notes to do it, because if the computers failed, I can go to the grocery store and I can pay with hundreds as opposed to my credit card. Well, none of that happened, of course, we know, but that facility got a tremendous amount of usage by the banking system. Today, we would call that quantitative easing. But in 1999, we effectively didn't have the name quantitative easing. So when we hit that 183%, the Fed was easing. The Fed stopped being tight, and we had this effective QE. We were pumping money into the system, and it all went into those technology stocks. In April of 2000, the Fed ended the special facility, and then in May of 2000, Greenspan started making noise again about raising rates, and everything turned around and fell down, because if it didn't get more money, it wasn't going to be able to continue to rally. In November of 21, we're coming off COVID. We had the CARES Act. We had tremendous amounts of fiscal stimulus. Remember, we were mailing people money. That's how much fiscal stimulus we had. The Fed dropped rates to 0. It blew up its balance sheet. We rammed a whole bunch of money into the system. Where did it go? It went to GameStop. It went to meme stocks. We were buying zero-dated options. We were speculating, day trading on options at that point. The stock market in November of 21 was on a tear because the Fed and the federal government were just feeding it with money, and it was all going into that. What happened then in November of 20? That's when Chairman Powell came out and said, we got to stop using that word transitory. And by March of 22, 4 months later, they started what was to eventually become a 500 basis point hike in interest rates and did quantitative tightening. And the stock market, the S&P fell 24%, the NASDAQ fell 38%, Bitcoin fell 77%. And so they all wound up crashing. So now here we are back at 180%. And where are we right now? We've got the AI stocks booming. We've got Bitcoin booming. We've got all this stuff going up. And we've also got, at the same time, these demands from Wall Street that the Fed has to cut rates, has to stop quantitative tightening, has to feed the beast with more money. Now, if the Fed does that, we could continue. But if the Fed doesn't find a reason to do it, because inflation's too sticky, the economy's too strong, maybe they're just worried about frothy markets, looking at Bitcoin and the like, and they refrain, we might run into trouble. Again, we're recording March 5th. March 6th and March 7th is going to be Chairman Powell speaking before the House and the Senate in his semi-annual testimony where he gives his assessment of the economy. March 8th, it's going to be the payroll report. Both of those events, Powell speaking and the payroll report, are going to go a long way into telling us if we're going to keep feeding this beast with more money, because right now we've only got enough money to take Bitcoin, gold, and 4 stocks higher. Everything else is kind of treading water for the moment. And that's really what we're going to need. We're going to need. That's why I think Wall Street keeps demanding that the Fed cut rates, because they know they need more money. They know they need more capital. There isn't enough to go around. We saw this in 2000. We saw this in 21. And when the Fed took away all the easy money, these markets really started to struggle. They're not struggling yet because there's hope the Fed is going to give it more cheap money. But if that goes away, it will become a problem in the future.
Jim, thank you for your thoughts today. Thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again and have a great day.